And welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it's actually been quite a busy day for the markets, unlike what we've had really over the last week or so. We've had plenty of economic data to absorb. There's been some commentary throughout the day as well, which is having quite a big impact on the markets. I think the biggest of which came from John Williams overnight. He is a member of the Federal Reserve, although it's important to note that this year he's actually not a voting member of the FOMC. And John Williams actually raised the possibility of changing the Fed's mandate to accommodate the new market conditions that we currently have, in which we're approaching the Fed's inflation target. We're seeing unemployment, which is within the range that the Federal Reserve deems to be full employment, and yet economic conditions don't necessarily warrant a rate hike. And what he's saying is what we may need to look at is the possibility of something along the lines of higher inflation targets to fall more in line with the new environment that they find themselves in. And this has really hit the dollar today. This has been seen as a very dovish signal for the markets. While he's not a voting member himself, maybe one of the reasons he's saying this is because it potentially reflects the viewpoints of other FOMC members, and it's something that's a possibility somewhere down the line, and maybe suggests as well that there is a reluctance generally within the Fed to continue raising interest rates. So we saw the dollar actually taking quite a hit earlier on. Still at this stage down 1.2%, the biggest hit coming against the Japanese yen, which actually broke through 100 today. It's currently trading just back above, and this now has, just before we've started recording, come off the fact that we're hearing from Fed's William Dudley. Now, he's one of the permanent members of the FOMC, and therefore a voting member, very senior policymaker, and he's really just said effectively the opposite to what John Williams said overnight. He said there is still a potential for 2 rate hikes this year, so clearly pointing towards September as a possibility. He said the US election doesn't weigh on the policy decision, and I think most importantly, he said it's premature to talk about raising the Fed's 2% inflation target. So clearly this is something that is playing on the policymakers' minds, but as far as this very senior policymaker is concerned, it's too early to even be considering this. So we are seeing the dollar starting now to reverse some of its losses, but we have still seen some quite substantial moves so far today in the market, something which we'll touch on in a little bit. In terms of equity markets, we are seeing European equity markets trading around 0.5 percentage point lower. The US, which opens in about 45 minutes time, is marginally lower, coming off the all-time highs, which we saw reached yesterday. We're seeing oil trading around 0.5 percentage point higher, but nothing really compared to what we've seen as of late. The biggest moves, like I say, so far today have come in the yen, and again this is something which we'll touch on briefly, but first let's take a look at today's economic data and what it means for the markets. And as you can see, I have really narrowed this down because there has been an awful lot of economic data, so I just wanted to really highlight the key points. There was no real surprise in the RBA minutes, first and foremost, very much in line with what we were expecting. They cut interest rates at the last meeting, they remain cautious. The risks to the economy still there, things like moderate growth, low inflation, high exchange rate. These are they're continuing to be the commentary which we are getting from the Reserve Bank of Australia at the moment. The key data releases this morning were the inflation data from the UK and the economic sentiment surveys from Germany and the Euro area. The key points from the inflation release this morning. First and foremost, it's worth noting that this is a July reading, so this comes the month after the Brexit vote, so starts to take into consideration the impact of the Brexit vote on prices, more importantly the result of the depreciation of sterling on import prices. And this is one of the reasons why I've highlighted the PPI input figure here, because you can see from last month we had minus 0.5%. The trend for the PPI input figure has been increasingly getting increasingly higher, but has been in negative territory for quite some time now, and instantly in the first month since the vote we have seen that jump out of negative territory for the first time in a long time and rise by 4.3%. so instantly we are seeing the depreciation of sterling having an impact on prices at the manufacturing input level. This hasn't yet been passed completely onto beyond the manufacturing stage, you can see the output prices rose only 0.3%. Again, moving out of negative territory, so headed higher, which suggests we are going to see higher consumer price inflation going forward, but it hasn't been properly passed on yet, so it looks like that's being absorbed at the manufacturing level at this early stage. That's unlikely to last for too long, and I would expect to see that passed on to the consumer, like I say, going forward. We did see the CPI reading actually tick higher though, to 0.6%. We do continue to see deflationary pressures on the CPI figure coming from things like food and non-alcoholic beverages, with this ongoing war between the supermarkets continuing to weigh on the inflation. Transport as well, as a result of low oil prices, but again, I think the sterling depreciation is going to start to lift that in the coming months, and core reading as well, ticking down slowly in line with expectations. But I think we're going to have to wait for till the end of the year, maybe early next year, to really start to see the impact of the depreciation in sterling on the CPI data. We did see a pound rally on the back of the inflation data, and again that was driven by the PPI input predominantly, showing that this depreciation of sterling again is having inflationary impacts. In terms of the euro area, we saw a rebound in the ZEW economic sentiment figures for the euro area and Germany. Germany rising from the euro area rising from -14.7 to 4.6, far better than expectations, and Germany rising from -6.8 to 0.5, which was slightly below expectations, but a big rebound. I did mention last month that the significant decline in these figures was probably a bit of a knee-jerk reaction to the Brexit vote itself, and now we have seen a rebound in this figure. These figures still are very low, and do suggest that there is going to be some, it's at least believed there's going to be some ramifications for the German and Eurozone economy as a result of the Brexit vote, but that knee-jerk reaction has passed now, and people are clearly a little bit calmer than they were immediately following the vote. In terms of the US, we've had some housing starts and building permits data, but the key one was the CPI data, especially considering it came after John Williams' comments, but prior to William Dudley's comments, and this slip in the CPI figure to 0.8% and 2.2% on the core reading gave a little bit of another kick to the US dollar, and helped get help dollar yen fall as low as around 99.50 after this release, although that did quickly reverse these following the comments a few minutes after from Dudley. And again, still as I'm talking now, we are back above 100 on dollar yen. Still to come today, we've got industrial production and capacity utilization data. We've got we're going to hear from Fed's Lockhart as well, so it'll be interesting to see what his views on this are. And we've also got the API weekly crude oil stocks still to come. And one more thing I'll just touch on is the charts, because I'm not going to go into too much detail on the charts, but we have had some big moves today, so I just wanted to quickly highlight them here. You can see euro dollar, we've pushed through what that 112.30 resistance level. We moved as high as 113 on the back of the weakness in the dollar, but we are now coming back. It will be interesting to see what these 112.30s do if this holds as support. 112 to 112.30 if this holds as support following that break, or whether we're going to see a complete reversal in the dollar. We've seen cable come off its lows and move towards these 130 levels, but again, the weakness in these comments from Dudley do seem to have taken the edge off that. The 130 level currently holding. If we do see a move back to the downside again, it will be interesting to see these 128s to 129s, the lows from the last few months. Dollar yen, again, 100 is a massive psychological level and previous level of support. 99 is another one, which we could see significant support here should we see another break through that 100 level, if we do see the dollar regain some of that weakness, considering the rebound which we have had. And dollar CAD was another one where I think we saw a big move, because we've got this nice trend line here. We broke through these key moving averages, we've broken through these most recent lows, and if we can see a hold below this lows, these 128s to 128.50s, then we could be looking back towards these 126.50, 127 levels, which was the lows back from June and May. So like I said, we've seen some really big moves so far in the markets today, and it'll be interesting to see if we can keep it up as the rest of the session goes. We've still got more economic data to come, and on top of that, we've got more comments to come from the Federal Reserve, and clearly this is a story which is dominating markets so far in this session. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.